So as we switch to the next part of this opening session, we have a presentation now, and that will be made by Lara Smith, and she's the Managing Director and the founder of Core Consultants. She'll be talking about the most important elements and where they are mined within Africa. Lara's got over 10 years' experience in analyzing commodity markets. She began her career as an equity analyst for Forward Asset Management, where amongst other sectors she analyzed the junior platinum miners and as well as soft commodity as well as the soft commodity markets. She was then hired as the lead analyst at the Steinmetz Group, and Lara is local to the region, having received 2 degrees from the University of Cape Town down the road. So without further delay, can I invite Lara onto the platform, please?
Yes, I need that. Good afternoon, ladies and gentlemen. Thank you to Mining Indaba for having us back here again. Thank you, Raju, for that wonderful introduction. For those of you who are unacquainted with Core Consultants, we are a focused mining and consultancy group. We offer benchmark analysis, customized commodity reports, pre-feasibility and feasibility studies, price discovery and time series, subscription reports and valuations. At present, our subscription reports offerings include the manganese market, the rare earth market, and the ferrochrome and stainless steel market. This year, I've been asked if I could take a different approach to minor metals and rare earths in Africa. Over the last few years, I've chosen to focus on 3 commodities, and then we discuss the trends and dynamics of each of these commodity groups. This year, I've been asked to instead look more closely at minor metals and rare earths markets, treating them as a single sector, and then look at how Africa could play a role in this global trend. Additionally, we have been considered to consider whether Africa could actually overtake China as a supplier of rare earths and minor metals, as China supplies majority of rare earth and minor metals today. This is, of course, no small task, because minor metals and rare earths actually incorporate, if you take the Minor Metal Trade Association's definition, it incorporates over 48 commodity markets. Therefore, whilst there are unique dynamics in each of these markets, for the purpose of this presentation, I've tended to focus on those themes that are common to all of them. So where relevant, I'll use specific examples from commodity markets to best illustrate these ideas. Based on this, I've structured the presentation as follows. First, we will look at what minor metals are, the current global trends, and why they are important. I will then look to discuss the issues facing rare earths and minor metals. And finally, we'll consider whether Africa can indeed supply these minor metals and perhaps overtake China to some extent. All right. So let's start looking at the first idea. Each year, the European Union and the United States Defense Department update their critical metals list. Some of those metals, which are deemed critical in terms of supply, in that supply risk is high, and also that they are important for the continuation of the modern day of life. If we look at the upper right-hand quartile, these are the metals that are most critical. The majority of these metals actually are minor metals and rare earths. In order to illustrate the importance of these metals to our modern way of life, we need to first identify and define what exactly modern day of life really means. At Core Consultants, we believe that there are 4 global trends which drive and define our modern world. They can be summarized in 4 main categories. These are an increasing trend towards portability and miniaturization, the preservation of energy and environment, the urbanization of populous nations, and increasing instability among nations. In response to these global trends, a number of key industries have developed which characterize our modern world. We consider a few of these industries and illustrate the use of minor metals and rare earths in supporting these industries. So the first one is an increasing trend towards miniaturization and portability. We see evidence of this trend in everyday life. These include the uptake of cell phones and smartphones instead of fixed lines, laptops and tablets instead of desktops, television screens which have been replaced by smart screens, and large hi-fi sets and boomboxes that have now become iPods, and a growing trend towards sourcing more efficient batteries, lighter batteries. So the lead-acid battery has now been replaced by the cobalt-samarium battery or a rare earth containing battery, and many others. An example of the trend towards portability can be seen by the uptake of smartphones and mobile PC subscriptions. If we take subscriptions as a proxy for production, we now note that as of 2014, there are about 3.3 billion mobile subscriptions. In 2020, we expect this number to increase to 5.6 billion, representing an 11% compounded growth over the next 5 years. If we consider the metals needed to support this growth, a typical smartphone requires around 33 elements. 22 of these elements are minor metals or rare earths, and around 13 of these are actually in the upper right-hand quartile and are deemed critical metals. The second trend is the preservation of energy and environment. Energy scarcity and clean technology are major world concerns. Wind, solar, and nuclear energy are now being developed to supplement the traditional electrical generation. In addition, countries are attempting to limit carbon emissions through the various initiatives, including promoting electric vehicles. If we just consider wind and solar power, this is a graph showing the wind power growth expectation, and we note that by 2018, which is just 3 years away, this is expected to grow by 6% compounded annually. Solar power is meant to increase by 4% compounded annually. And again, if we consider the metals required, and I've highlighted also in grey those metals that are found in Africa, we know that for each of these technologies, they all require different metals, but each of them require minor metals and rare earths to sustain themselves. In the case of electric vehicles, there are 9 critical minor metals, including rare earths, cobalt, lithium, vanadium, silicon, needed to manufacture a typical electric vehicle. The third major theme is the urbanization of populous nations. And today, for the first time ever, more than half the world's population, 54%, reside in urban areas. This compares to 30% in the 1950s. Going forward, it is expected that by 2050, 2/3 of the world's population will actually be urbanized. In 1990, there were 10 megacities, 10 million inhabitants in each of them, and this contained around 153 million people living in megacities. As of last year, there were 28 megacities, which were home to 453 million. And by 2030, this is projected to increase to 41 megacities and be home to over 600 million people. Currently, 54% of China's population resides in urban areas, and this is expected to increase to 60% by 2020. Simplistically, urbanization of populous nations necessarily needs to be supported by key infrastructure developments. These include the increased number of buildings, an increase in the number of modern homes, which need to be fitted with household goods requiring ceramics, glass, electricity, and lighting. In addition to expanding the number of urban settlements, this also needs to be done in a sustainable way, ensuring that pollution is controlled and energy is used efficiently. One example where we see evidence of this is in terms of the uptake of LED lighting for households compared to the less efficient halogen or incandescent lighting. LED lighting makes increased use of rare earths as opposed to halogens, which look at more common materials. And the fourth and last major theme is the increased instability among nations. And this we can consider in 2 ways. First, it is the physical security, and therefore we see an increased expenditure on defense. And the second is that countries want to ensure their self-sufficiency with respect to resources and energy. And we see evidence of this most recently in the movement towards natural gas, which has started a price war with the oil producers. And also we see evidence of this in the number of joint ventures and mergers between nations that require resources, typically the developed nations, and those nations who need resources, typically the emerging markets. One example quite close to home is the rare earth market, where we saw South Korea's Kores Group invested in African-based rare earth projects Zankopsdrift and Montero Mining. With respect to military expenditure, the combined military budget of Japan, China and the US is forecast to increase by 4% compounded annually between now and 2030. China's defense spending has increased fourfold over the last decade to 808 billion won, or $132 billion. And what is particularly interesting about Japan is if you look at the graph, they've actually had 10 years of static military expenditure. But for the April 2015 budget, Japan has requested that this budget is increased by 3.5% in response to growing concerns over the rapid military buildup of Chinese military. Japan is also increasingly wary about North Korea, as the North Korean missiles are actually in range of the archipelago islands. And last year, the Japanese Defense Ministry put out a white paper indicating that North Korea was a seriously debilitating factor for Japan and the world. In the context of rare earths and minor metals, nearly every type of military equipment, from night vision goggles to jet engines, require either rare earth metals or minor metals. So we now move on to the second part of this presentation, where we look at the challenges facing the rare earth and minor metal sector. If we consider that we have just shown that these minor metals are vital for the continuation of our modern way of life, we then need to consider the supply and demand projections. And what we show here is two projections, one for 2016 and one for 2020. And there is a number of commodities where there is an imbalance or we're facing a critical shortage or deficit. But actually, this is only half the story. And if we had to ask the manufacturers of these key end-use industries where they procure their raw materials, the majority of them will actually answer China. And as we can see by the map, China is a producer of the majority of minor metals. And again, this wouldn't be an issue, except that China now makes up 44% of the market share with respect to supply of minor metals and rare earths. And this has been increasing steadily over the last decade, as in 2000, China only comprised 28% of the world market share. The second major issue is that the government policies within China are aimed at supporting domestic production and ensuring availability in China for Chinese end users. This factor has led to an international reliance on Chinese supplies, giving China monopoly over minor metal prices and supply. In recent years, the rare earth grabbed market attention around this issue, though the rare earth industry merely epitomizes and highlights an issue that is actually true for a number of minor metals. Therefore, we have this trend towards self-sufficiency. And in truth, these issues are continuing today. The increasing dependence on Chinese minor metals has forced end users to consider how to deal with greater price volatility and increased production disruptions. One development that has resulted is the motto ABC, anywhere but China. To this end, Africa presents some interesting opportunities as it boasts 30% of the world's mineral resources. And as we try to illustrate on the map, Africa has got very diverse resources and is home to many minor metals. However, whilst Africa does represent over 8% of global mineral production, if we look at the exploration expenditure in Africa, Africa remains low at $5 per square kilometre compared to 65 square kilometre in other mining jurisdictions, including Canada, Australia, and Latin America. This is mainly due to the high level of political and social and infrastructure risk in Africa, resulting in companies wanting a higher return for a lower fixed investment outlay. So the question that was asked from me is can Africa actually usurp China as a major supplier? So the short answer to that is no. But to understand why, we need to consider the reasons for Chinese success and to contrast this to the reality facing African mining. In addition to being naturally endowed with the vast resources, China's success in dominating key commodity supply chains can be attributed to three main factors, namely the low cost of production and government support, domestic market growth, and lax environmental regulations. If we consider the low costs of production and strategic government support, this is inextricably linked to a myriad of Chinese government subsidies and policies aimed at supporting domestic production, and this weaves its way throughout the entire Chinese economy. At the macroeconomic level, Chinese exchange rate policy further enhances the country's natural production cost advantage provided by its large population and developed coastal infrastructure. China's managed float of the yuan often looks like a peg to the dollar and ensures that production input costs remain below a natural market level. This provides manufacturers of Chinese goods with an advantage over its international competitors. In the minor metal industry, government support goes much deeper and includes energy subsidies, which are particularly attractive to energy-intense industries like metal smelting and refineries, as well as value-added tax or VAT rebates on exports of many of these refined metals and metal products. More recently, government has also started to subsidize downstream products such as the purchase of white goods like refrigerators and washing machines, and the country is now contemplating a subsidy on electric vehicle batteries. If we contrast just the idea of a stable exchange rate to Africa, we note that mining and manufacturing in Africa is particularly exposed to the exchange rate movements, as we see on the graph here, and the level of imports required in terms of input costs in many cases offsets the benefits of a weaker currency from exports. Another consideration is the support for Chinese producers of primary metals from which minor metals are extracted as byproducts. If we look at the China Tin Group for the extraction of indium, if we consider Hebei iron and stainless steel for their extraction of vanadium, if we consider Baotou Steel Rare Earths for its extraction of rare earths, all these enterprises have got one thing in common, namely that they are state-owned enterprises. In China, the role of a state-owned enterprise or an SOE, their first and foremost responsibility is to provide stable jobs for Chinese. As such, resource extraction levels are to some degree buffered from price fluctuations in the market, meaning that production continues regardless of the economic conditions. Contrary to China's SOEs, the majority of African companies rely on private investment for developing its resources, and as such, profitability is the main goal and not job stability. Therefore, African mines are much more sensitive to fluctuations in price than their Chinese counterparts. One example, which we can see on the graph, is in 2009, the economic downturn, whereby refined cobalt production outside of China fell by 11% to 25,000 tons. Within China, Chinese production actually increased by 21% over this time, allowing China to take significant market share as a refiner. Not only is Africa dependent on direct private investment to develop its extractive industries, but within China there is a high dependency, as out of 54 countries, 24 of them rely on very few mineral products with relatively low value to generate more than 75% of their export earnings. This is because the economies of the majority of these countries are not diversified enough from an industry perspective. This has led to a high dependence on mineral rent, which contributes to supply disruption caused by external shocks and low levels of economic development. As such, despite the abundance in natural resources which Africa has, this is not translated into sustainable economic growth. Additionally, most African companies have an indigenization law that requires that investors partner with local groups in developing the mining assets. All too often, government objective to provide stable jobs is often set aside in favor of lining the coffers of the elite. For this reason, the Fraser Institute, which ranks the top mining jurisdictions in the world, ranked the DRC at number 93 and Zimbabwe at 91 out of 100. Therefore, despite the vast and varied resources, these mines need to offer a much higher return in order to attract investors. But not all economic factors pulling the minor metal production to China are directly due to government involvement, policies, and influences. As noted, China has a natural labor cost advantage and a strong export infrastructure. These two are critical factors in attracting natural manufacturers to set up production in China. In addition to this, China also is very competitively priced from a raw materials perspective. And also, China, due to its number of end users, is now you have a proximity to the world's largest manufacturing base. As China is now buying manganese, cadmium, cobalt, molybdenum, tantalum, and vanadium, we can understand that the manufacturing base in China is actually increasing. If we contrast just this labor phenomenon to Africa, Africa has a large unskilled labor force, but in many cases it is heavily urbanized, it is heavily unionized. And as we've seen over the last 2 years, and particularly in South Africa, these unions have the power to destabilize mining operations and disrupt supply. Moreover, if you look at the charts, this is research done by HIS Analytics, and it shows the disconnect between labor productivity compared to the unit labor costs. Moreover, Africa's manufacturing capabilities are severely diminished due to the high cost of infrastructure and limited supply of power, which has seen Africa lose out to jurisdictions in the East. The level of industrialization in Africa is low, with the majority of Africa's minerals still exported without any downstream processing, thereby reducing the potential derived value. If we consider South Africa as an example, over the last decade, our manufacturing export, as shown in the graph, as a share of our total exports, has declined dramatically. And the last reason cited for China's success is the significant difference in the level of application of environment protection regulations between China and the majority of Western countries. This has often been identified as a decisive factor in explaining the movement of industrial production and manufacturing to China. However, in recent years, because of the new leadership and the recognition of China to the importance of the environment in preserving the environment for long-term economic stability and improving the life of its people, although there are still discrepancies between the nation's policies and the local enforcement, we do see evidence of increasing environmental stringencies. One example was actually highlighted in our recent rare earth report, where we saw that Chinalco rare earth was suspended and forced to stop production due to being charged with violations of environmental standards. In the past 18 months, also staying with the rare earth example, we have seen Baotou Rare Earths, the largest light producer in the world, denied its share of production quota based on environmental issues. Whilst in Africa, mining has been associated in some countries with environmental issues, deforestation, land degradation, and pollution, which often does lead to social strife, Africa, and in particularly South Africa, when compared to China, has generally been more in line with Western environmental standards, which does add to the cost of mining. So in summary, we have considered the importance of minor metals and their contribution to the modern way of life. We have shown that industries have developed in response to 4 global themes, including a trend towards portability, urbanization of populous nations, preservation of energy, and increased global instability. All these industries have placed an unprecedented demand on minor metals and rare earths. As such, these metals are starting to make the lists of metals deemed critical by the EU and the USA, and if we had to consider other countries such as Japan, they too would be very similar in terms of their critical shortlist. Contributing towards the critical nature of these materials is the fact that China is the dominant supplier and in recent years has implemented policies to preserve their natural resources for their own domestic development. The question then arises as to whether Africa, in light of its vast resources and home to many mined metal deposits, can rival China with respect to becoming a major global supplier. Unfortunately, compared to China, whilst Africa does hold 30% of the globe's mineral wealth, Africa's policies from a macroeconomic perspective differ greatly to that of China in respect of the high level of dependency on private investment, the high level of dependency on rent-seeking, the volatility of the exchange rate, and the low productivity of its labour force, which make the continent less amenable to developing its resources and create a stable supply base. Thank you.